I'm Jeff Shahusky. I'm from Green Bay, Wisconsin, and I run a hard money lending company.
How much did you raise at Dealmaker a couple years ago?
So a couple years ago, Jim made an announcement because I had said I wanted to raise $10 million, and that weekend I was offered $10 million and $30 million. Now, it's one thing I would actually like to talk about because sometimes you should say no. I'm just saying, sometimes you should say no to amazing offers because they're not as good as you think they are.
And Tom, I mean, you've raised more private capital, I think, than anybody I've met. But go ahead and introduce yourself.
Tom Berry out of Houston, Texas. Run several funds and hard money lending company. We lend in about 28 states, and we buy shopping centers in the Sun Belt of the United States.
Okay, next, Bill.
Bill Fairman, Carolina Capital Management. We are out of Charlotte, North Carolina, actually Rock Hill, South Carolina, because most people don't know where Rock Hill is. We are private lenders. We have two funds, an equity fund and a debt fund. Both of them are evergreen. We'll get into that in a little bit.
Next, all right, so we got all these lenders, lender. Oh, and then you, to both of you.
I know. Wow.
So go ahead, tell us all about yourself.
Yes, my name is Rebecca Taylor. I am from Lynchburg, just a couple hours away, and our company is Tailored Investments. We do multifamily and assisted living syndications, and we've invested around the country, both in GP and LP positions, and so I really look for solid partners to do deals with. We're working on a 100-unit property in Lynchburg, and it's been really fun to give people a lot of great benefits of investing in real estate without all the headaches of being a landlord.
And we talked earlier, like we're going to give you some hard questions about investing in multifamily right now, right? And you're good with that. All right, Tim, you just did a mobile home park. Tell us more.
Yeah, my name is Tim Davis. I'm from Lakeland, Florida, and I'm glad to be here with everybody. This is a great group. I have residential property that I own. I also have a property management company, and I'm involved in several syndications as a limited partner, and we just did a mobile home park syndication back in May. So that's my first one as a general partner.
I love it. And fun fact is that Tim is a pastor's kid, just like my wife Cheryl, and they followed each other in houses in New York many years ago, which was a crazy story. Randy, go ahead, introduce yourself.
Randy Shelley from Chattanooga, Tennessee. Been in real estate since 2008. Done a bunch. We've been running, me and Tony have been running a hard money lending company now since 2018. I'm in multifamily throughout Alabama and Southeast, and I've got self-storage.
And Wendy, can you introduce yourself and Tom? Oh, Tom, you
Let
go
Tom.
first. Wendy, you go. We're saving the best for last.
You go ahead.
Tom Olson, we build and manage rental portfolios for investors. We also have a hard money lending fund, and we do a bunch of other fun stuff. Yes, exactly.
All right, and Wendy?
Wendy Sweet, I'm partners with my brother Bill, Carolina Capital Management. We have a couple of funds. We have self-storage facilities, short-term rentals, and mid-term rentals, and
That's a lot.
I'm thinking that's all at this point.
Does somebody want to guess how much the total of their funds has currently under management? Anybody? 300 million? Tom, what's your guess for this panel? Half a billion with a B.
Yeah.
500
yeah.
million. So do you think they know how to raise private capital and put it to work legally in a fund? Okay, this is your chance to ask questions. We're going to call this the $500 million, the $500 million panel. Okay, Wendy?
Let me ask a couple first.
Yes. No, I'm going to let you ask.
Let them have
Go ahead.
Let them have that mic.
Here you go.
All right. So really, what I really would love for you all to get out of this panel right here is you don't have to have a fund to raise money. You don't have to be in a fund to lend money, but it's wise for you to be able to do that. I really want you to understand how funds work, the different options that there are out there. And if you have money that you want to invest, like your self-directed IRA, there's some questions that you need to ask every fund operator that you're talking to. Same with syndications. I also want to talk about the difference between syndications and funds. There's a big difference. So I guess the first thing I wanted to really ask is, Tom Berry, will you tell us the difference between a fund and a syndication?
Yeah, and I'm not an attorney, so this is not legal advice. But my understanding of the difference between the two is in a syndication, you have one asset and multiple investors. And with a fund, you have multiple investors and most generally, multiple assets as well. At least that's the case in all of ours. There's also legal ramifications to the difference between a fund and syndication, but I'll leave that to Jeff Watson and some of the other attorneys in the room.
What made you start a fund?
You know, our private lending company, we started lending with our own capital, like most of the lenders on the panel probably, and then friends and family money that we had raised. And we got to the point where we had more deal flow than what we could provide capital for. So it just made it easy for us to advertise and get into higher net worth individuals by opening a Reg D Exemption C fund, which is a fund class that you would use for accredited investors only. And by doing that, we were able to advertise it to the general public. So that's why we did it. And you know, when we started our first one, we thought, man, if we could get to 25 million in that fund, you know, gosh, that would just change the world. And that particular fund has 106 million in it now. So it can really take on a life of its own once you get it rolling. And for us, the key to that was track record. The longer the track record, the better the track record, and the longer the history, the easier it is for people to jump on board and get excited about your vision.
Now, there's also something that's called a debt fund and an equity fund, and some funds have both debt and equity. Bill, can you explain the difference between that?
No.
I'm telling Mom.
So an equity fund, essentially, you are an owner of the business of the fund, and you're going to get paid or returns based on the profit of that business. So you'd get a K-1 at the end of each year, just like you would if you owned a piece of any other business. On a debt side, you're essentially lending the fund money, and you're going to do it with a term, maybe a 1-year term, a 3-year term, a 5-year term, whatever the fund has set up in those guidelines. The benefit of an equity fund is that most of them will allow you to compound your returns over time. So the upside is the longer you're in it, the more you're going to make, the higher your return is going to be. And then on the debt side, you know exactly what you're going to get every month because you have a fixed payment. Is that helpful?
Now, so, stop it. Okay, so Tom and Jeff and Randy, and what was your name again? Please forgive me. Tim, do you all lend in one state or more than one state?
I lend in we did one loan in Alabama, but mainly Tennessee and North Georgia, yep.
Okay, and you guys lend in one state, right? Or one or two?
About 15 states that we
You're in 15 now?
We're not in 15.
I was going to say you're
15 that
nuts.
We will lend in.
Okay, so
We have 8 right now. That we
you have 8. So the point is, some lenders are really focused in their backyard, and some have the courage to lend across, right, Tom? Some have the courage to lend across the country. So how do you do that? How do you underwrite across the nation and not in your backyard? What are some of the things that you have to do that are different? Yeah.
You're looking at me? All right. Well, we started in our backyard, right? We started in Houston. Every loan we did for the first 2 years was in the Houston Metroplex, where we knew, and we had infrastructure. And you know, I wanted something bigger. I wanted to go bigger than just my backyard. So we did a pilot test in Dallas, Texas. And you think, well, that's not really a pilot. Yes, it is, because I know nothing about Dallas. If y'all don't know about Texas, Dallas and Houston are 5 hours apart, okay? Knowing one does not mean you know the other. It's a big damn place. So we tested it in Dallas, not having any infrastructure and not having any knowledge of that local market, by using a lot of the same things that we learned from Alicia, and that is processes, systems, and automations. And what we found was we did not have the wheels come off. We did not have mass foreclosure. We didn't have any issues. We were able to lend there just as easily as Houston. So then we reached out, and our next city was Columbus, Ohio. Why Columbus? Well, Columbus is a judicial state, not a deed of trust state, or not a non-judicial state. So we said, let's try the whole opposite end of the spectrum. And again, the wheels didn't come off in Columbus either. And after that, we knew from those 2 beta tests that we would be able to duplicate our model anywhere we chose to go. So then it was just doing a study of eviction laws, and we said any state that has laws that are worse than Ohio, we won't go to. And Ohio that's the worst we will go to. And any state that has foreclosure laws that are better than Ohio, absolutely, we will lend there. And you know, one by one, we just added more and more states until we got to where we are now.
So your marketing is different, right? You're having to expand your market, go to different states, rather than concentrate just in one state like you are, Jeff. You're highly concentrated, right?
Correct. I've taken the stance of trying to keep all of our private capital, regardless of where it comes from in the country, in my backyard, so we can do a better job of babysitting, right? That's the way I look at it. Borrowers don't typically like it when the lender babysits. But oftentimes, borrowers don't know how to behave properly. And so, so we take a highly consultative or educational approach to working with our borrowers. And the demand within just our single state is really, really high. There's not that many players that are coming to Wisconsin. Now, I can lend outside the state. That I'm not restricted to do that. The private capital, it's a choice, right? If I'm going to do lending outside the state, I want to broker the money through someone like Tom or a different fund and play with somebody else's money, right? Because I don't know, it's just the way that I prefer to do it. I really like to take care of people as much as possible. So it's a different viewpoint.
I like that. Randy, how do you feel about being concentrated?
I'm very concentrated, because when I say North Georgia, I'm talking about just the 2 top counties that touch Chattanooga right there. So, I mean, we've got a little over 10 million on the street. I'm always, every time I get more money, I'd have it tied up extremely fast. So I'm more capital constrained than I am location constrained. So my goal was to tap out Chattanooga first, which I think we could probably put another 10 million on the street. My goal was to go to Knoxville next. I know Longhorn originated 40 million just between Knoxville and Chattanooga. That'll keep me busy for a while. So
That's awesome. Jeff, I heard somebody in your area went a tad belly up because they were lending a little crazy.
They're not belly up yet,
Yeah?
but they're really, really struggling. They stay pretty local as well. They're actually the largest in the state. We're the second largest. And they kind of did the exact opposite of what Tom was describing about trying to control and underwrite to do the tests and stuff. They got way too loose with underwriting. They charged a higher interest rate and higher points to do it, but they made the underwriting so loose that investors just came out of the woodwork and funded stuff like crazy through them. And right now, they're pulling back 25 and 50 plus property portfolios plus multifamilies, and I mean, and the problem with the way that they structured their stuff, because they do have a fund as well, but they also took their fund and they leveraged the fund with bank money behind it. And so now the banks are starting to call those loans due, which is why they're really, really struggling. And all of their investor capital right now is at risk. Because not only did they pledge the investor capital, they also pledged all the mortgages and notes as collateral.
And guess who gets paid first?
The bank does, right? So they're really hurting because they are really trying to make sure that they don't lose, they don't go out of business, but their investors right now are just terrified of what's going on with their business.
Tom, did you want to say something? Go ahead.
I'd love to add something. This is happening all over the country, not just in Green Bay. I travel all over the country speaking on, as most of the folks on this panel do, and we're hearing that same story over and over and over again. We've got some big lenders in Houston that have no capital. The banks have pulled their lines. They do not have their credit. So, back 10 years ago when we started our fund, everybody said, including my competitors, they said we were stupid in the way we built things because we didn't take any bank money and we didn't take any Wall Street money. Still to this day, our funds do not have any bank or Wall Street money behind them. So it was just investor capital, and I call that sticky capital. Sticky capital is capital that will stick with you as long as you're doing your job as a money manager, as long as you're running things the way you said you would, and you're still delivering the returns you always have. The people in this room that are invested in my fund are not going to get scared and pull their money out tomorrow because they read something on the Fox News article, right? But banks will. Bankers run scared. And when they get scared and they pull a $30 or a $50 million credit line, you're out of business if you built your business on bank or Wall Street money. So it's happening everywhere.
Plus that leverage, they've got those loans, go ahead, Bill. They've got those loans set at such a high rate because it's usually based on what? Yeah, it's a floating rate. So as rates went up, their money got more expensive. Does anybody on here have bank money?
That's why I started my debt fund last year.
Good
Is
for you.
because,
Good boy.
but it was a small portion, and it was about $3 million compared to the $10 million that we had on the street. But I'm wanting to pay that off because what happened last year, my bank money got more expensive than what I'm paying my private money, and they're a pain in the butt, and I don't even want to deal with that anymore.
Right, go ahead.
Here's one of your due diligence questions. If you have an IRA and you're investing it in a fund and they're leveraged, now you're subject to UBIT tax. So a lot of people
Talk
don't
about
know
what that is, Bill.
I don't know. It's a damn high tax. And it's on the profit on your IRA because the IRS does not like you to leverage your IRA. So if you're investing in a fund that is leveraged, unless you're the lender, if you're in an equity fund and you're a business owner with your IRA and that fund is leveraged, then the IRS says you're leveraging that money. It's no different than you using your IRA to buy a house with and you're getting a mortgage on it. You have UBIT that you have to pay on that as well. So anyway, that's a question that you should ask if you're investing in an IRA. Any fund that's got, do you have leverage?
So, speaking of leverage, I was at a conference, and just like this conference, and there were multiple lenders that had come in and were offering services to help the investors. One of the lenders at that conference was offering 15% interest to all of their investors. Okay? I tell you the story because as I listened, because their booth wasn't that far from mine, I actually heard someone ask them, what do you charge your borrowers? That's a question you guys should answer or ask, because their answer was 8%. Now, even if you don't ask them, are you leveraged?
Is that new math?
There is only one way that you can get an 8% return that you're charging your borrowers and paying a 15%, and that's through leverage, because you're multiplying the money supply by 4 and 5x, So if you're charging 8% and you get, say, 5x, nice easy math, right? Do the math, that's 40% return. So can I afford to pay 15%? Just know that that's a very high risk, high leveraged portfolio when they start making big, big promises.
It's a great point. Let's talk a little bit about syndications. So why did you choose to do a syndication? You both have one?
Yes.
Awesome. Let's
Yeah.
hear it.
So I got involved in syndications about 3 or 4 years ago. I started investing my own capital in syndications to see how that worked, and got really excited about raising capital like that because I've always been able to raise capital for my own deals, and then to raise them for larger deals was kind of interesting. So we chose to do a syndication on a mobile home park last year. Simply because I wanted to see how it worked, and I wanted to be the asset manager and actually do it. So we did use a lot of people's IRA money, but we didn't leverage any of it. So we raised all of the capital for the mobile home park using syndication, and that's how we did that. So it worked out pretty good for.
So what did the terms look like in that syndication?
So the terms, our offering was a 7% preferred return for all of our investors, and 15% IRR is what we're looking at as a, that's what we hope to do. It's a 5-year hold, reposition, and then we're going to be selling it. But the thing about it was when we did this is interest rates were starting to edge up a little bit at the bank, so we didn't use any bank funding. We used 100%, raised the capital 100%, and so we were able to start from day one giving our investors their 7% preferred return, which they really appreciate that. And
That's
they're
awesome.
asking when's the next deal, so that's.
So my background, my husband and I started investing in real estate in 2012 and just did it on the side while we were in W-2 jobs. And my thought was real estate's always got to be a landlord. You got to buy your own property, manage it, deal with all the hassles of toilets and tenants and trash. And I didn't realize there was another way until 2020. We stumbled into the passive investing realm and came across a group locally called Wellings Capital. And I worked for them. They were doing fund of funds and had multiple assets. So they weren't lending, but it was all hard assets and mobile home parks, self-storage, multifamily, light industrial, a number of different assets in that fund. And so I was able to work for them as their director of investor relations. And it was a really cool experience getting to invest our money and see the benefits of, again, getting to do it a little bit more passively, but also help other people do the same. And so I transitioned to another firm where we were just doing singular assets with just singular syndications with value-add multifamily. And so now we do that on our own with partners around the country, and it's been a really cool journey. We do use bank money because I do think there's power in leverage, but we've seen over the last couple of years with interest rates skyrocketing, a lot of my friends, unfortunately, have taken out adjustable rate mortgages, and they have suffered from those the numbers just not working anymore like they thought they would. Maybe they didn't buy rate caps, and now they're in a situation where they can't make their debt service, and also they can't pay their investors. And so there's a lot that you should be aware of, like do the due diligence. I cannot stress that enough. I mean, there's a lot of people that have lost money in this, so be careful is something I would stress. People project a lot of things, but ask about the track record, find out all the nitty-gritty, ask other investors. You do a lot of research before you go and put your money with them because you don't want to end up losing all of your hard-earned cash, obviously, in a deal. And so debt, when you're thinking about going with some bank financing, I think it's great that you guys did 100%. I mean, that's a different way of doing it, but there's a lot of validity to that too. So I think it just depends on your strategy and your risk tolerance too.
Okay, rule number 1, Warren Buffett, is never lose money. Rule number 2, check rule number 1, right? Summarized all of that really quickly. But I will say Rebecca was here last year and she was pregnant. And this year, her baby.
So cute.
Isn't that amazing? This is like deal maker. And then her father, BG's from Montana, and I guess in the back with your little one. So I'm just going to give a shout out to all the mompreneurs, okay? So, because you guys juggle a lot of stuff, okay? Kids, businesses, cash flow, paying people, all of that's a lot for moms with kids. Wendy, we got time for like one more, and then we got to go to Michael Robertson. Michael, are you in here? Oh, come on up front. Okay, go ahead, Wendy, last
Are there
one.
any questions out here?
We could take at least one question, yes.
Wait, Tom, I think Tom has something.
Tom, what do you got to say? What's on your mind here?
Well, we do, when we're buying our shopping centers, one of the things that I always tell potential investors is when you're talking to somebody that's offering a syndicated deal, ask them what their assumptions are. Because anybody can put on a piece, and look at the heads going up and down, right? Because anybody can put on a piece of paper, target return 25 to 30%. And that's great. And I'm not saying that it isn't possible, right? There are deals where that is possible. But I want to see the underlying assumptions they used to get to that number. And if they're not willing and they're not able to very quickly and efficiently and concisely give you that information, run. Because if you're looking at one of my shopping center deals and I'm telling you I can get you 20 to 25% and that's our target, I guarantee you within 2 minutes I can show you my assumptions and how I got to there. And if you don't agree with my assumptions, if you think they're pie in the sky, you should just walk, right? Because you should be buying their assumptions, not their target. I hope that makes sense for everybody.
That's good stuff.
I always say, Tom, I think if you can't explain it to your partner or your spouse at like an 8th grade level in less than 5 minutes, then you don't understand what you're investing in. Do you agree?
100%.
You guys all agree?
So how many people on here have accredited investor-only funds? Okay, anybody have non-accredited funds available? So, whether you're accredited or not, you have an opportunity to let your money work for you. You have a job, you're investing, you're an entrepreneur, you're working for that money. Everybody has money that they need to invest to. And your self-directed money, you should be lending with it. And this is a great way to do it, is to invest it in one of these funds, especially, any of them compound? Who's got compounding? There you go. That
Wow.
means you're leaving it in there. What we talked about, the magic of 72.
72?
Right? So
The rule of
let your money
72.
work for you. You've got options up here.
I love it. Bill Fairman, you just published a book. Do you have that with you? Yes. Okay, so we can see you about that. Tom Berry is speaking tomorrow morning at 8 a.m.,
Woohoo!
which Tom's always a favorite. Tom Olson, tomorrow afternoon for the Mastermind. You want to give a 30-second preview?
Just be there.
Don't miss it.
It's going to be the most epic mastermind ever.
Still trying to
Okay.
figure it out, aren't you, Tom?
All right. All right, we're going to, Wendy, can you transition your lavalier?